false evidence number 2, which is impending recession will bring down the housing market. So what are your thoughts with respect? You and I went over the history of recession versus the real estate market. So we can go over the historical data point. So go ahead. What is your perspective? Will the recession bring down the housing market?
No, the recession is not going to bring down the housing market. The recession is really it's slowing down. I mean, we look at what the Feds are doing. They have got to counter inflation. They've got to bring inflation down. And so their tool to do that is to increase rates, right? Now, how is inflation determined by the government? Again, I don't necessarily agree with their number, right? But CPI is what they use to measure the rate of inflation. And housing or shelter is a third of that calculation. So if it's a very large percentage of determining inflation, then they're going to focus on moderating that as much as they possibly can. So with recession, and let's just look at data. I'm gonna quote Neil Bawa, who you so beautifully introduced me to him through a podcast that he was on with Toby Mathis just last week. Yep. And data that I was not aware of until Neil shared it. And if you look at what housing has done in the last, out of the last 9 recessions, and they were shallow. I know we talked about this, is it a deep recession or is it going to be a shallow recession? Historically, when the Feds are trying to fight inflation, the best thing that they do is to raise rates, and then that cools the market. And so when you've got out of the last 9 recessions, the Feds were really good about keeping it shallow. Shallow meaning, if you're on an incline like this, then you plateau a little bit, and then it's a sharp up, it's a leveling off, and then it's a sharp down. But then the shallow means about 9 to 12 months in a recession, and then what happens is you come back to where you were on the initial trajectory. So they just have to kind of put the brakes on. They're just pumping the brakes, right, to kind of get things back under control. And then what do? They want to stimulate growth again. And so they then make capital a bit more readily available for less cost. So that is what that is their mechanism for controlling what we do as consumers and as spenders in the United States.
Anything else you wish to say?
I'm trying to remember exactly what point number 2 was.
Will recession impact the housing market negatively?
So I think you're good. Thank you. So I'll just say this. I'll wrap it up. I'll just say this is that usually, historically, if you look at the data, during times of recession, interest rates usually tend to come down, which then stimulates the housing economy. So that's the history. That is the data that we have to go off of. I haven't seen anything different than that. I'll share another data point that came from David Childers with Keeping Current Matters. He's a great infographics, and he looked at the last 6 recessions in the United States. And what did housing do during those 6 recessions? Well, 4 out of the 6, housing values increased, rents increased. And so there was only 2 exceptions to that, and that was 2008 and then 1982. So I just use data, Seewing, and that's the thing, because the facts don't lie and facts don't care about your feelings. It's easy for us to get caught up with our emotional brain and our logical brain. Emotional brain tends to win out with, you read housing crash, housing chaos, and you have to learn to just cut through all of that, because there is opportunity in recession. There's opportunity outside of recession. It's just, you just have to have the mindset, the data, and the history to really be prepared and make the best decision for you as an investor at that moment.
I absolutely concur. And my quick takeaway is that if there's a recession, technically we're not in a recession yet. If the worst case scenario, we're going to have a recession soon. I predict it's going to be a very mild recession, 6 to 9 months long, and it's not going to affect the real estate market because the fundamentals are still strong. We still have a shortage of homes, and the demand is still pretty high. So and people still need a place to live, and people, consumers, homeowners and renters, they don't care about recession or crash or whatever. They just need a place to live. So and there's a shortage of supply. So yeah, recession should not impact the resale market. We'll soon find out. All right.
Actually, I think I would say for us as real estate investors, it actually benefits us because there is going to be some short-term pain, for more into some industries more so than others. There will be some layoffs. We're already seeing some of that because they need unemployment to rise, right? And wages to soften to curb the spending, right? And so you make things more expensive or you lay people off and the unemployment rate goes up, and then you have less consumers consuming and buying things. And then now you've got the CPI coming down. So there will be some pain for some industries. I mean, you were seeing some layoffs now. We're seeing some stores closing now. And Bed Bath & Beyond announced that they were closing some stores. So this is not like we're painting this rosy, beautiful picture, right? But what we are saying is it's short term. And for us as investors, if people they need a place to live, it's an absolute must. Then if they can't afford to buy something right now because of the upward pressure on interest rates, or they're scared about losing their job, or maybe they have lost their job, they have to move in with other people, they have to maybe downsize and maybe rent something for a little bit longer than they wish to. And so it really positions us as investors by providing a really good service to these types of individuals who need a place to live, can't afford to buy it themselves right now. They need a place to stay while they're rent. And so it really is it's an opportunity. It's a really good opportunity for investors to continue to expand their portfolio, buy rental properties, because the need for housing is great.
Absolutely. I will further your point by right now we are already, in my opinion, is the greatest renters nation in history. There are more people are renting right now than ever before, based on my opinion of being in this industry for so many years. And then even under the worst case scenario, if the recession were to hit, if there are unemployment situation, you have more people going to be in the rental pool, if you will. So as like you said, to support your view as a real estate investor, there will be more people, there will be more renters that are fighting tooth and nail to rent your home as a landlord. So there are really in certain markets, there are already bidding wars for renting. So therefore, as real estate investors, if you get into this game, the current and future tenants will be the highest quality ever because they are because you can screen so many renters. You pick the best one, so they'll be a Class A renter. They're gonna pay your debt, making you wealthy. That's the bottom line. So right now, yeah, you can make the argument right now it's the best time to become a real estate investor because the rental pool is so historic, so epic out there.
And let me just share a data point, because I think a lot of times anyone that's listening, this sounds nice, it's a nice conversation, but just for us, our property management side, we have the highest occupancy rate that we have ever had in our nearly 10-year career in this industry. We are sitting at 97.6%. I don't have enough rentals on the market to meet the demand for all the applicants that we have. That they have to qualify. That's the main thing. But if anyone's listening and they're looking for, well, that sounds really nice, Seewing and Maureen, but how does that translate into what you're seeing, boots on the ground? And boots on the ground is not only are we capturing the max end of the rent range. I'll give you an example. We had a property, we projected the rent at $13.75. We got it the same day that we listed the property. We got an application and then a security deposit shortly following thereafter for $14.25. So the competition is fierce for renters, and it puts us as real estate investors in a very good position because we can, if we have the property to offer the renter a place to live temporarily or maybe for a long time, depending on their financial situation, we're commanding the higher rent. We're renting them as very, very quickly and to the tune of where we usually run it between 95, 96% on average as our occupancy rate. We're at 97.6 and still climbing.
Well, absolutely, Maureen. I could not agree with you more. And as a matter of fact, any investors that they need to lower their expectation, at least right now, in terms of cash flow situation. Yes, with a higher interest rate, right? And the cash flow is not that great right now so far, but get in the game, buy your property, even a low cash flow. But for the foreseeable future, the expectation is you're going to increase your rent quite nicely. So the cash flow will improve. So yep, that's how it is. The rental rate is gonna increase more so in some markets than other, but things are looking good for this investor, for those that can overcome F.E.A.R.
And I know you like to keep these short, but I do want to share this with you because I tapped my good friend Keith Weinhold, from the owner and operator of Get Rich Education. I tapped him on the shoulder the other day, and I was asking him, because we know the fundamentals, there's 5 ways that real estate pays you, and it's through appreciation, cash flow, loan pay down or the amortization schedule, the depreciation or the tax benefit, and then it's a really good hedge against inflation. And so I love what he did, because he did this on a video recently, and he said, look, out of the 5 ways, do we as investors expect all 5 to be increasing and in our favor at all times, right? And you kind of think, yeah, but I do want all that working in my favor. So with market conditions as they change, then some of these parameters, the fundamentals don't change, but maybe how you win in some, maybe you take a little bit less, you take a haircut on the others. And I love what he said, because he said, look, because you look at the 5 ways, and I'm going to cheat because I have my little paper here. But he said, look, appreciation right now is moderating. It's waning from the previous 2 years, right? So we got crazy on the capital appreciation or the equity growth in the last 2 years. It's just moderating now. It's waning now. It's not depreciating. I think in some markets it is, but it's not overall nationally depreciating below the value of the current asset. And a lot of forecasters and housing experts are calling for a 2 to 7% increase by the end of the year, right? So overall for 2022, on average, 11%. And this is CoreLogic, MBA, NPES, all of the ones that forecast and measure. This is what they are saying. This is not what Maureen McCann is saying. This is what the housing analysts are saying, right? So is appreciation going down? It's moderating. It's maybe coming back to the correction, like you were saying, to maybe correct levels of maybe appreciating 3 to 6% versus the 20, 30% that we've seen in some markets. That's number 1. Number 2, the cash flow, that one is increasing. And the reason it's increasing is because we're getting the higher rent, right?
Right.
The principal pay down, that's waning. The principal pay down is waning because we have higher interest rates to contend with, right? And that's not working in our favor. The tax benefits are the same. They don't change. They don't care. Tax benefits don't care what's going on with interest rates, right? They just do what they do. And then inflation profiting is increasing. And so if you look at the 5 ways, you have 2 that are increasing, two that are moderating or waning, maybe back to market normal levels, right? Because you can't keep that, you can't sustain that hot, crazy market that we were in. We all loved it. We all wanted to keep it going, but it doesn't work that way, right? So we're having a, call it a correction. And then you have one that stays the same. So if the messaging there and why I share that is if you're trying to time the market to figure out when to get in, no one's ever really been successful doing that. And the 5 fundamentals are the 5 benefits to us as investors. And if the deal, and I think you said this on a previous Seewing, you said, if the deal works, the deal works. If the cash flows, even if it's not a high dollar amount like you would want, if the deal works and all expenses are paid and you still cash flow, it works, and continue to do it, because then you have other tools, let's call it in the future, where you could, if you want to change that interest rate, you have the option to refinance out of that to a lower rate when that option is available. No one knows when that option is going to be available. We all suspect it's coming. We don't know when. So in the meantime, are you going to hold out building your nest egg, your portfolio, increasing your net worth, or you're going to choose to sit on the sideline until an interest rate seems more agreeable to you? But let me tell you about that last point. When interest rates are low, guess what companies like us do? We just increase the price of the property because we can, because the deal still works. But when the interest rates rise, guess what happens to pricing? We soften it a bit, which is what we're seeing.
Wow, that makes so much sense. So here's my my take on it. Even today, 7% interest rate, which is high, you will not agree. I could even make an argument that even the Federal Reserve will increase the rates, which they plan to do several more times before the end of this year, 2022. Let's say the worst case scenario, the Federal Reserve will increase the rate to 6.7% for owner-occupied buyers. This means that investment mortgage rate will probably going to be 7%, 7.3%. Even at 7.3%, you and I know with the kind of properties we're promoting, investors should buy because they can still cash flow a little bit on the price point that we have, given the numbers that we project with the cash flow analysis. So yeah, even the higher, investors have the ability to adapt. If you're a primary homeowner, we will discuss this on another video. Primary homeowners have only one scenario to succeed: the monthly mortgage payment, right? If the interest rate is so high, which is right now, many of the primary home buyers they can't afford anymore. They are staying in the sideline. But investors have so many different ways to enter the investment real estate market, which is totally different than primary home buyers. We'll talk about that in the next video. So 7% interest rate, 7.3% mortgage interest rate for investment loan. You guess what? Out there, investors out there, you can still cash flow at 25% down payment if you buy in the right market, if you buy in the right affordable market in the right area of the country, and you surround yourself with a right team of people that can make these deals happen, which is happening to which is applied to you and I. So Spartan investment.
True.
So I will leave you at that, and then thank you for your perspective.